Investors, I got a story for you. The other day I was outside doing my usual back and forth pacing when I accidentally ran into a youth. We started chit-chatting about life, space travel, his parents' recent divorce, when I eventually had to ask him, what do you think about the recent market turmoil partially caused by an overreaction to a potentially quickened pace of interest rate increases by the Federal Reserve? He stared at me blankly for a bit and then replied, "It doesn't matter to me. All my money's in Bitcoin." I stared back at him for a moment, disgust washing over me, and then I proceeded to slap him across the face. Now investors, you know AK doesn't believe in violence, but there that youth was, on the ground, unconscious, drooling. And I thought to myself, is it possible that he's not the only one that doesn't know the importance of central banks? Do people not understand how much of an impact the Federal Reserve has on financial markets and their money? Well, if that's the case, then clearly I gotta do something about it. Today on Fallible, I'll be exposing how central banks manipulate financial markets. Understanding the Fed's motives and how they achieve them will help you protect your money in these violent financial markets. What's happening, investors? AK from Fallible here. Let's start with the basics. The Federal Reserve is the central bank of the United States. It was originally created in 1913 to address all those bank panics we used to have.
Here's $2,000. This will tide us over to the bank reopens. All right, Tom, how much do you need?
But nowadays, the Fed abides by what they call a dual mandate, meaning two mandates. Mandate number 1, maximum employment. Mandate number 2, stable prices. And mandate number 3, moderate long-term interest rates. Now, none of those mandates actually requires that the Fed be able to count, which is why you may have noticed that the dual mandate actually involves 3 mandates. And with these bankers' wives getting pissed off at all the mandates their husbands were going on, the Fed thought it was better to officially say there were only 2 mandates total. The first mandate of maximum employment is obviously important because people need jobs. Without jobs, people become bums that live on the street, or even worse, millennials that live in their parents' basement. But just like a dual mandate doesn't actually involve 2 mandates, max employment doesn't actually mean every single person is employed. It really just means a natural rate of employment. So about 5% of people can be unemployed and we could still safely call that max employment. And 5% unemployment is a good thing, because that way the people that actually have jobs have someone to make fun of and throw rocks at. The second mandate of stable prices is important so businesses can plan for the future. If there's too much inflation or deflation with prices moving too fast, it becomes tough to do business. And businesses want no business doing business in a business environment not suited to business. It just wouldn't make good business sense. So the Fed gave themselves the extremely easy and super simplified goal of keeping inflation at exactly 2% a year. Makes sense. The third mandate of moderate long-term interest rates plays into this. Because if inflation is too high, then interest rates go higher too to compensate lenders for the loss of value in their money. And I promise you, nothing good comes from inflation and interest rates getting high together. Those two are only trouble. You can see how all 3 of these mandates fit together. Stable inflation and stable interest rates creates a good business environment where businesses can grow and employ more people. But how does the Fed make all this happen? Well, you can think of the Federal Reserve as the godfather of the US banking family. He controls all the other banks with 3 tools. And yeah, 3 actually means 3 this time. 1, reserve requirements. 2, discount rates. And 3, open market operations. The first tool, reserve requirements, is the amount of cash a bank needs to hold as a percentage of its deposits. As you know, banks work by paying people a small amount to hold their money, and then taking that money and lending it out to others for a much higher price. It's a fantastic racket. Honestly, if I could do it all again, I would start a bank myself. I would call it AK Bank. It would be refined and French. The reserve requirement determines how much banks can actually lend out. And the Godfather, aka the Fed, determines what that is. If he wants businesses to expand, meaning more loans and more money in the economy, then he lowers that requirement. If he wants to tighten up and take money out of the economy, he raises that requirement. Now the Fed's second tool of control is the discount rate. This is the interest rates that banks pay on short-term loans from the Fed. Banks come to the Godfather when they need something.
You said you'd come into my house on the day my daughter's to be married and you asked me to do murder.
So the Godfather gets to set the terms. And this rate affects every other rate for bank products like mortgages, loans, credit cards, you name it. Again, if the Fed wants the economy to expand, they'll keep this rate low. If they want it to contract, then they'll keep it higher. Now the final tool the Fed has is open market operations. Some of you may know this as quantitative easing, or that dirty little acronym QE. This is when the Fed creates money out of thin air, buying government bonds from banks. The hope is that the banks will take that money and then inject it back into the economy. The Fed can also sell bonds back to the banks to take money out of the economy. And what do you ask makes the banks agree to buy? Well, in the old days, the Fed would send over a guy and he would...
I'm gonna make him an offer he can't refuse.
But nowadays, because everything is digital, the Fed just texts everyone an emoji and they buy right away. And there you have it. The Fed has 3 mandates. 1, maximum employment. 2, stable prices. And 3, moderate long-term interest rates. And to achieve those mandates, they have 3 tools. 1, reserve requirements. 2, discount rates. 3, open market operations. So then how does this affect you? How does your money and savings get manipulated throughout this process? Well, it all goes down through a little something called risk premium spreads. And I'll be shedding the light on that process and how you can protect yourself from it in the next episode of Fallible. So make sure you subscribe to this channel and don't forget to hit that bell. The bell is the only way you're gonna get an email about the next video. So do it now. I'll wait. And I'll see you again in the next video.